I think real estate in particular is a massive bubble because it's been subsidized by a number of factors. One being artificially low interest rates. So as the Fed suppressed interest rates, kept rates at zero, and in fact, not only was it buying government bonds, but it was buying mortgage-backed securities, it kept the cost of financing homes artificially low. People can go out and borrow money to buy a house and pay, 3%, 4%. And that enabled borrowers to pay much higher prices for the homes because most Americans, when they buy a home, it's not what it costs, it's what are my payments. And they simply look at the monthly payments and whether or not they can swing them. And with interest rates artificially suppressed, that made it possible for people to pay much higher prices. Now, that doesn't necessarily benefit the buyer, that benefits the seller. The seller got to get the higher price. The buyer is stuck paying it. But the other thing that the government has been doing for a long time to, prop up real estate prices is by guaranteeing mortgages. So when you have Fannie Mae, Freddie Mac, FHA, they go to a lender and they say, hey, we guarantee this mortgage. So if this guy doesn't pay, the U.S. government will pay. That makes the borrower a better credit risk, and that qualifies him for a lower interest rate. And in fact, once you've got the government guarantee, that's pretty much all you need, right? It's like a bond. And so that also allows people to buy houses with lower down payments or maybe no down payments, with higher debt levels or where the mortgage payment is a higher percentage of their income, because it doesn't matter if the guy defaults, if it's a guaranteed. So that means that people get better terms. Home buyers get to qualify for a larger loan than would otherwise be the case in a free market. So because of all these government subsidies, real estate is much more expensive than it otherwise would be. So, and again, that doesn't benefit the buyer of the real estate. People think, we need the government because it's making housing more affordable. It's actually making it more expensive. It's making the monthly payments lower, but the actual cost of the home is higher. And so, you get a government guaranteed loan, but now you're having to borrow a lot more money. And so you have a much bigger mortgage. If the government was completely out of the housing market, prices would be lower. And so real estate would be more affordable. You'd have to pay a higher interest rate, but you wouldn't have to pay as much to buy the house. So you wouldn't have to borrow as much money. You could look and say, we had mortgage rates of more than 8% in the 1990s. And, you go back into the 1980s, they were more than 10%. Yes, that's true. But housing prices were a lot lower. And so you didn't have to borrow as much money at that 10%. And other costs were lower, insurance, taxes, maintenance, things that homeowners would have to deal with. Those costs were lower. And, Americans, by and large, had more savings at that time. So they could actually make a larger down payment. And so they didn't have to borrow as much of the price. So that because the mortgage money only affected what you borrowed. So if you put 20, 30% down, right, you only had to pay 10% on the 80%. But people today, they got no money to put down. Maybe they're putting 3 or 4%. So they're borrowing 96, 97%. And now they got to pay 8% on that. So it makes the rate more expensive. But the key, the bigger factor is the price of the house itself. Home prices have gone up dramatically. In fact, look at how much higher real estate prices are now than they were 3, 4, 5 years ago, when you could get a 3% mortgage. Now it's 8%. Number one, they held interest rates down at zero. So long-term treasuries were low. And so the mortgage rate is kind of a function of that because of the government guarantee. But even the jumbo loans that the government wasn't backing, in a low interest rate environment, there were still buyers for those loans because people were stretching for yield. And so they were, willing to take a little extra risk, especially if it was collateralized by real estate. But that distorted the whole market. We did the same thing leading up to the 2008 financial crisis. When the Fed brought interest rates down to 1%, it wasn't zero, and they didn't stay there as long. But the private sector was able to create these products based on the low interest rates where they, bundled these mortgages and basically, created this subprime market and enabled, people with low credit scores or low down payments to buy homes that they previously might not have qualified for. And that helped fuel a lot of demand. And there are a lot of people buying 2 homes, 3 homes. And all of this was, pushed up the price. And we had this huge bubble. Then you had people taking out home equity loans. People were extracting the gains from their real estate and they're spending it or using it to buy more property or just to, buy a new car, take a vacation. So we had an entire bubble economy based on the inflated value of real estate. And then, I knew back then that it was going to end badly when the teaser rates reset and people couldn't make the payments. But this, I think, is a much bigger problem that we have now in the real estate market, particularly for the lenders, because in 2007, 2008, when the bubble popped, the banks lost money on the default. Homeowners weren't paying their mortgages because the homes were worth less than their mortgage, and maybe their teaser rate expired and they didn't want to pay the higher price. And so the banks were in trouble because when people were defaulting, they were getting back the collateral and the collateral had lost value. Right? But the vast majority of borrowers did not default. So most of the mortgages were okay. And that still created, this banking crisis. And a lot more banks would have failed and they should have failed had they not been bailed out. But today it's a different story. The banks are losing money on all the mortgages, even the mortgages where the borrowers are current. In fact, right now, the banks would be better off if more people defaulted because then they can sell the properties and get out from under these mortgages. Because for years, as Americans were refinancing their mortgages over and over again, and then locked in these rock bottom rates, right? You got some people actually have 30-year mortgages in the high 2s, right? Right after COVID, they went below 3. And everybody thought this is great. Homeowners are really, improving their balance sheets. They're locking in these 30-year mortgages at these rock bottom rates. And what I always pointed out, and nobody seemed to care about it, was sure, it's great for the borrower, but what about the lender? What about the banks who are stuck with these low mortgages? Because eventually the Fed's not going to have interest rates at 0 anymore. What happens when they go up? Well, now you have rates at 5%, but the banks are only collecting 3%, 4%. They're losing money on every mortgage they have on their books. And the bigger problem is their depositors are withdrawing their money because the banks can't compete with the government, which is paying over 5% on the money market. The banks can't give you that kind of rate because they don't have the money anymore. They loaned it out for 3%. So now depositors are coming to their banks and withdrawing their money. The banks don't have it because it's tied up in these long-term mortgages or treasuries. And they're all basically insolvent. And a lot of these banks are going to the Federal Reserve and they're taking their underwater collateral and they're giving it to the Fed. And the Fed is giving them 100 cents on the dollar, even though it's only worth 60 cents on the dollar. So I think the whole financial system is insolvent. I think all the banks that were too big to fail that we bailed out are now even bigger and they're going to fail, but it's going to be even worse for the economy because we made them so much bigger because we bailed them out the last time. They've reduced the balance sheet from about 9 trillion to 8 trillion. But yeah, before COVID, we were under 4. So they have a long way to go there. But then, before the 2008 financial crisis, the balance sheet was less than 1 trillion. So if we're going to take away all that emergency QE, we still have $7 trillion to get off the Fed's books, which it's never going to do. In fact, I'm not even sure how much longer they can keep shrinking the balance sheet. I think by next year, sometime before the election, they're going to be ramping it up again. They're going to be trying to prop up the economy the way they've always done, except this time it's going to have a much different effect because in the past, when they were doing, quantitative easing, the official inflation numbers were much lower. But now that you have high inflation, and then if they throw gasoline on that fire by going back to QE, you're going to see an immediate impact on consumer prices. They're just going to start rising even faster. The short-term effect could be to reduce the rates, but in the long run, it's going to push them even higher because in order to do that, the Fed has to create a lot of inflation. And as that inflation works its way through the economy and lenders want to incorporate that larger loss of purchasing power into their interest rates, ultimately, the inflation that the Fed is creating is going to cause interest rates to be a lot higher, at least nominally, because you have to be compensated for that loss. So if inflation is 10%, you're not going to loan money for less than that. You got to at least break even, but people aren't loaning money to break even. They're trying to get a positive return. So you've got to get a return that exceeds the rate of inflation. And a lot of lenders are paying taxes too, so you have to have an after-tax return that exceeds inflation, which means, a much higher rate. Eventually, they should go a lot higher because, again, we're going to have very high inflation, and so that's going to push up rates. So, we could see mortgage interest rates into the double digit, and that has to have a depressing effect on home prices because most Americans are not cash buyers. I mean, if you're just paying cash, then it's not as important what the mortgage rate is. Although some cash buyers might borrow the money someplace else, and so interest rates are still a function of what they're going to pay for a piece of property. But your typical home buyer, he can only buy what his credit will allow, because he doesn't have the money to buy. Like, a lot of Americans can't even buy a car, let alone a house. I mean, how many people pay cash for their cars? So I think Americans are broke. They're struggling to buy food, to pay for insurance, healthcare, energy, utilities. I mean, just the basic necessities of life are increasingly out of reach. I mean, look at the jobs numbers. We just, got at the jobs report last week, but again, a new record high, 7 or 8.5 million Americans, I forget, are working multiple jobs. I mean, moonlighting is becoming commonplace. Very few people now can make it on one job. So you need to have 2 jobs. You need to have 3 jobs. Whenever they report all this jobs, the jobs are going to people that are already employed, and they're just, having to work, on the weekends or work in the evenings because they just can't earn enough money at their main job. So they need another source of income to cover the rising cost of living. The home buyers, if they would have just let home prices crash and they didn't bail out the banks, a lot of the borrowers would have been able to renegotiate lower mortgages. Because if your house is only worth, let's say you bought a property for $400,000 and you borrowed $350,000, and the house is only worth $200,000, right? Well, you're not going to pay your mortgage. I mean, you owe $150,000 more than the house is worth. But if the bank forecloses and sells it, what are they going to get? They're not going to get the $350 that you owe. They'll be lucky to get the $200 that it's worth. Well, rather than doing that, they could just go to the current home buyer and say, look, you're not going to make your payments clearly. Let's do a new loan. Your house is worth $200,000. Let's give you a new mortgage for that. And then we'll recalculate the rate. And then now you have some incentive to make the payment rather than foreclose on it and go through all that. I mean, the banks would have been in a position to negotiate with the borrowers, and the borrowers would have had a lot of leverage given how weak the market was. But the government didn't let that happen. The government came in and bailed everybody out and bailed out the banks, and so a lot of those deals never had to happen. But still, a lot of people still were smart. They just walked away from their properties and they feel like, I'll just buy a brand new one. I mean, why? The market's gone down. But I think the banks, again, are in worse shape today because the problem isn't with the mortgages that default, it's that all the other ones that are current. The banks are losing money on every mortgage they wrote if they still own it. Now, some of the banks flipped them, right? They originated the mortgage and then sold it. They didn't keep it, but somebody kept it. Somebody owns that mortgage. Now, the U.S. government owns a bunch of them, right? Because they were buying up mortgage-backed securities. But a lot of them are owned in the private sector, and they have huge losses. Most Americans now, their biggest asset is their mortgage. Even though it's a liability, it's an asset in that they borrowed all this money really cheap, and they couldn't do that today, right? I mean, you can't borrow money at 3%, but if you locked it in, that's more valuable probably than your house. Because even if you don't want to live in the house, you could rent it out and make a nice profit based on what you're paying the bank and what you're going to collect from your tenant. But the other problem that the banks have today, that is a huge problem, not equally for all the banks, but for the banking system, is commercial real estate. Because commercial real estate is a complete disaster. And it wasn't a problem in '08. In fact, commercial real estate went up because rates went down and commercial real estate prices rose, as rates fell, which is what they do. But now, you had 10 years or so where interest rates were at 0. And so commercial real estate was very overpriced. And now that interest rates have risen, that rental income stream is not nearly as valuable. But the other problem is the rents have collapsed because there's no tenants, or there's a lot fewer tenants. So people are working from home. And so a lot of office space is empty. A lot of companies have realized I don't need as much space. Just today, officially now WeWork has gone bankrupt, but WeWork has a lot of space in a lot of buildings that's now, now back on the market, in a market that already is oversupplied. Then on, the retail front, with all of the online commerce going on now, there's not as many people that are just going to a strip mall or shopping center or the big malls. They're just buying from home. So we don't need all that retail space. So the retailers, either they can't pay for it or they don't need as much of it. So that type of space is oversupplied. There's a glut. Office space, rents are falling, vacancies are rising, and real estate prices have collapsed. I mean, a lot of the big cities, and also some of these cities, these big democratic cities, they also have a big increase in crime, which is also driving a lot of the office market away because employers are worried about, their workers, getting assaulted or, and a lot of people too, even with COVID, some of the people that lived in those big cities have moved into the suburbs or further. And so there's a lot of office space, in these urban areas that's on the market. And even the retail, because, now in a lot of cities, they don't really prosecute shoplifting. So people are stealing stuff. And so a lot of people don't want to have stores because they can't deal with the losses. They can't deal with the higher insurance costs to cover the losses. So the banks are in a lot of trouble that have these commercial loans because a lot of them are going to go into default. And it's going to be like from '08 with the mortgages, they loaned somebody money to buy an office building and they paid $100 million and they loaned them $70 million. And now that office building is worth $50 million or $40 million. They just walk away from it. And now the bank owns this property, but it's not going to collect it. It loaned out $70 million and it got a property that's worth $40 million.
Yeah.